Hello, today I wanted to share with you a common thing that I help my clients with, and it's just addressing those old retirement accounts. So as you navigate through your career, you may have multiple employers from your past, and you start to accumulate these old retirement accounts. They could be called 401ks, 403bs. They're all different shapes and sizes, but basically, once you leave that employer, any contributions that you made directly into the account you're actually able to take with you or do whatever you want with. Basically, the employer doesn't really care. And so there's a few options that I'll definitely make sure we tackle here. I do have a strategy guide that is going to be more detailed than this, but I felt like a video would be helpful just because I know not too many people have time to read or even want to read a strategy guide on these things. So I'll hit on the highlights, but if you want to find out more, you can definitely check out my strategy guide on what to do with your old retirement accounts is what it's called. And so the simplest thing would just be to stay and keep your account where it is. Most employers allow you to do this as long as the balance is pretty sizable. Definitely if you're above 10,000, most of the time the employer will allow you to leave it there unless they have some special rules. So that's just easy, and that's what I find most clients do. They don't really weigh the pros and cons. They don't do any analysis. They just, if I don't have to do anything, I'm not going to do anything. And so that's just the path of least resistance, and that's what happens. That's not always the best thing for you, though. So we'll take a look at what factors you may want to weigh in and consider. The biggest thing is being the fees, the expenses associated with the account, as well as any investment option. So those things can vary greatly from employer to employer. So just know that the cost that you have with your old plan may not be the same as your new plan or some of your other old plans that are out there, or even what you could do on your own. So just that's an important piece to be aware of. So it's worth analyzing it and seeing where things compare and contrast. So make sure that there's no heinous fees that just overcharging for just basic maintenance fees. Most retirement accounts at this point shouldn't have too high of ongoing maintenance costs, but it is possible that you may see things start to be added on once you leave the employer, because sometimes the employer will kind of subsidize those costs for you while you're an employee. But once you leave, they may let you keep the plan there, but they're not going to keep paying for you to have that plan and not see those fees. So that's something just to keep an eye on. It's not too often that it occurs, but it is something that could occur, and it could easily rack up over multiple years. The two biggest things, though, I would have to say that make the biggest difference is going to be the expense ratios. Those are not easy to find. So those are tied to your investments. Most of the time, the 401ks, you would think they're free, especially if you don't see any fees coming out of it. But in reality, they're not. Any investments that you own within the account actually have their own expenses tied in. And even though you don't see it as a line item or a transaction, the value of the share that you own is reduced very small amount every single day that asset's traded. So every time that investment is trading in the open market on the day, the very small percentage of that gets kind of cut off, and it goes towards that expense ratio to pay the management company. So your investments are not free. Your 401ks are not free technically because there's these expense ratios. And just like I said earlier, there's a wide range as far as where you could fall on the spectrum, and it depends on your employer and the custodian and a few other things. But the main thing is just to know exactly where those costs fall in. You could see it as low as 0.15%, which is extremely low. That'd probably be using ETFs, which are not common right now in 401ks, but every now and then you'll see them, or you'll see index funds that will have pretty similar low costs. On the other end, though, I've seen expense ratios be as high as 2%. So there's definitely a wide range, and that's a big difference by a long shot, depending on where you fall in. Anyone that's watching this video, I could probably say you're going to fall somewhere right in the middle. You're going to be around 1%. And that's just kind of taking the average of what I've seen through my clients' experiences. The last thing is investment options. If you're not comfortable with investments, it may be fine not to have that many investment options. But what happens is sometimes employer plans become really restrictive, where you only have one option per category or specialty as far as where that investment can go. So it does get pretty restrictive, especially if they're restricting you to higher expense offerings, that may not be the best fit. So those are the things that you're definitely going to want to check. So make sure that we review all those things first before you even decide to think about rolling it over or cashing it out. Although cashing it out may just happen because of whatever you have going on in your life. The second most common, especially when I'm working with clients and we see what they have and if there's a better option out there, would be rolling over the account. So you can actually roll it over into most new retirement accounts. So if you have a new employer, most of the time you should be allowed to roll that into the new plan. You'll want to make sure with your new plan that they're going to accept it, because you'd hate to start moving it and then it gets kind of gunked up if for some reason your new 401k or your new retirement plan, whatever, 403b, whatever that happens to be, won't accept it. And then you kind of run into time challenges and just a pain in the butt factor. Another option is you can remove, or you can roll over those funds to a traditional IRA. That's going to be typically what's going to make the most sense for most people. But every now and then there's opportunities, or maybe you even have a Roth 401k where you'll roll it over into a Roth account. If you're not moving a Roth 401k to a Roth IRA, but you're actually doing a traditional 401k to a Roth IRA, what you're doing there is you're actually recognizing that you are going to be paying taxes on those funds that you're moving over, and you're doing a Roth conversion. So Roth conversion is pretty advanced. So unless you know what you're doing, I wouldn't recommend you go from a traditional 401k to a Roth IRA unless you know specifically what you're doing and how that's going to impact your taxes. So those are going to be the things you'll want to take a look at there. And then again, you're comparing those same things. What are the fees? What are the expense ratios? And what are the investment options? Once you choose to go on your own for those IRA and Roth accounts, because those are outside of your employer, really the whole world's open to you at that point. So investment options are endless, which may be overwhelming, may not be, may be exciting for you depending on how much you like researching those types of things. And then the final thing that really I feel a lot of my clients who are younger, if I wasn't working with them, or some of the people that don't know that they can work with an advisor and get guidance on these things, a lot of people just cash out their retirement plan. So every couple of years, if you're changing an employer and you're cashing out every single time, you're not making any progress towards your retirement goals, and so you're kind of permanently setting yourself back. And you may have valid reasons for taking out those funds and using those for today's purposes. I know a lot of people like doing it to pay off debt and things of that nature. But what most people don't understand is there's almost always going to be a 10% penalty unless you fall under some very tight guidelines as far as what is allowed for early distributions. But if you're younger than 59 and a half, that's an early withdrawal. So there's going to be a 10% penalty. On top of that, any traditional contributions from yourself or your employer are always going to be taxed as ordinary income. So that could push you into a new tax bracket. That could push you outside of different tax credits or phase you out of different deductions and things of that nature. So especially if you're thinking about doing with a really sizable amount, if it's just $1,000 or $2,000, it shouldn't be too big of a pain, other than you just are permanently setting yourself back that much further when you start to rebuild your retirement funds for the future. So keep those things in mind. Hopefully that's enough detail for you to get started. But if you want to find out more, you can check out my What to Do with Your Old Retirement Account Strategy Guide. And also, I always offer complimentary meetings. So if you have a couple questions and you really just need a little bit of guidance, if we can cover in 20 minutes, it's going to be free. But if it's something that's longer than that, we could always talk about what it would look like to work together and see if it'd be a good fit for me to help you with your long-term goals as well. So take care, and hopefully this was adding value for you.